let's get into the weeds a little bit and talk about principal paydown. Principal paydown is the byproduct of part of your monthly payments for your mortgage being used to pay down the principal amount you owe on the loan, thus reducing the amount you owe and increasing the equity spread on any potential gains or appreciation your property has made over that time. Okay. Now I know that sounded absolutely nuts. Even saying it, I'm kind of shocked it came out of my mouth in one take. Well, to be honest, it was like 6 takes, but it came out in one long string and it's quite a mouthful. So let's break it down a little bit. But before we do, we need to again understand fully why this is important so that you can stick through the video, because it can get a little thick, especially when you look at an amortization table. Understanding that when it comes to your primary residence, it is what is considered in the industry, mortgage industry, forced savings. It is a portion of your money that you are paying towards your mortgage payment that goes back into your pocket or into the walls of the property, and you can recoup it when you sell that property for a profit, okay? If it is an investment property, you get to make that money as cash flow, and not as direct cash flow, cash on cash, but it will be part of your income when you sell the property. Again, it's always important to know it's about selling the property because it's put into the house, because your tenant is going to be actually paying it down. That's one of the best parts of the investment side of it, is someone else forces that savings. The renter pays for your reduction in principal amount, therefore putting that money into your pocket and allowing you to cash out when you sell the property. Again, both of these assume that your appreciation has gone up or you have sold the property for exactly what you bought it for, and assuming some time has gone by to put those principal payments down. There are a couple caveats with selling a property. Obviously, you need to understand there's always going to be some seller costs associated with it, so you need to make sure to always factor in those numbers like real estate fees. Real estate agents are going to cost 3% either side maximum, so a total of 6% you always need to bake in when you do the calculation. But once you start to understand how an amortization schedule works, you can look at it really quickly and quickly calculate where you stand as far as the amount of equity you've gained from it, and you can hit your goals and actually decide when's best to cash out, or if at all. But understanding that you're taking some of that money and using it to pay down the principal amount and putting it back in your pocket, or taking someone else's rent and putting it into your pocket, is a really important part of making money in real estate. So let's jump into an amortization table on the iPad here and take a look at what it is, and I'll explain it a little further. So I have gone ahead and actually just typed in an amortization calculator on Google. You can go ahead and find them anywhere. Just obviously type in amortization calculator. Pick one of the first ones at the top. Doesn't really matter. They're all going to be the same. They all do the same sort of fundamental calculation. When it comes to calculating monthly payments over such a long time, like 30 years, you have some little bit in-depth calculations that need to be done. But you don't have to worry about it, because again, all these calculators exist and it's one standard formula that you can easily check. So let's take a look at an example and see what that's going to mean as an actual complete list of scheduled payments for the next 30 years. All right, so again, as I said, I've taken a screenshot of the actual thing so I can annotate it here, but this would be totally usable if it was on the webpage still. So I went ahead and chose a standard, kind of a first-time homebuyer amount, because I think this is something really important to understand for first-time homebuyers. I chose $300,000. I am currently based in Las Vegas. Now I know that is not a first-time homebuyer in California unless you want to get, a cardboard box, but it is something that I think that a lot of people can grasp onto, understanding how much that would be. So we're using 30 years. In this case, that is going to be obviously your standard for most mortgages for first-time homebuyers. And I'm just going to assume that this is the loan amount. So let's consider that you've put some down payment down. Obviously, being conventional or FHA, you're going to have to put a percentage down. But this is based on the mortgage amount. And that's also very important. It's always going to be calculated on the amount you're borrowing. It's not the amount, the total purchase price, it's the amount you're borrowing. Understanding that your equity is already kind of built in with that down payment. You're technically putting some of it into there. You get to pull that back out when you sell the property as well. But really important to understand that if our mortgage amount is $300,000, that it doesn't include the whole thing. And actually, let's put it down here so we don't forget it. So let's say purchase price is $350,000. Okay, so that means you had to have put $50,000 into this, and you're asking someone for $300,000, okay? So this we can end up using for our calculation when it comes to possibly how much you could pull out of in terms of equity when it comes to the principal paydown method. So again, I know I got a little stuck in the weeds there, but we're talking about 30 years or 360 payments. That's what this schedule is calculating. That means you're gonna make 12 times 30. That's 1 month for every year for, you know, the 30 years. That's 360. That's the other number that you may hear sometimes in the mortgage industry. I chose 3.5%. Current interest rates right now, you could probably do better, but 3.5, it's nice, conservative. It's not gonna make anyone get some false sense of hope. Let's just stick with it and see where it takes us. So the little blue button there where it says hide, I originally had to click it to show the amortization table, and you can actually see. Now, if you look on the right here, obviously I'm recording the whole screen, so you're privy to everything I am. You can see this long sheet. Now, this is the web page that it's captured, which is a great little feature of the iPad. I didn't realize it did this, but you can see what we're looking at here. Look at this, and it's going to take a little bit to render, but you know, now we're going down every single month through the years. And what this leads us to is all the way down here, is all the way to the end. 2051. That's going to be 30 years from now, right? In October, that we can understand that. And you can look, there's a final payment here, but I don't want to get ahead of ourselves now. I just wanted to show you that the whole thing has to be calculated out because that's what it is. It's you know, it's a grid, it's called the table because it's the whole thing. They give you this at the start of any mortgage, and it's something you can check into and take a look at. There's not much of a need unless you're trying to calculate kind of where you are as far as the equity gained in it. So let me show you how actually to do that and how this is represented. Let me change the color here and let's start at the top. So we are getting this with our start date right here. Start date is going to be today's date. I guess it's the day I'm calculating this. Yeah, sure, there you go. So 10/06. Our first payment on this guy is going to be for $1347.13. And we can actually see that number huge highlighted here in the top. The important thing to understand with any mortgage payment, with any payback of any loan, is that it is usually comprised of a principal amount and an interest amount. And that is shown right here. Now that was a horrible, horrible circle. Principal and interest amount right there. Those two together is this number here, is your payment. So $472.13 plus $875 is $1347.13. I'm not gonna do it on a calculator because I know it's accurate. Go do it yourself. That is the number. And if you look, what's really interesting is look at the next one down. It changes. They both change. This one goes down and this one goes up. And it proceeds to continue doing it. That's a minus, it's a plus. Okay? So this is going to be the best part that we're going to talk about. It actually increases as time goes on. But let's not get too far ahead of ourselves. The other part that we need to look at of the amortization schedule is that it actually shows us over here, it shows us, let's clear all these lines off here, it shows us the total interest and the total balance left over. These are important for two reasons. The interest gives you some sense of how much money you've borrowed this money from. So yes, you are paying for this privilege, but the way I always like to think about it is at least understanding that you had to pay for a dwelling somewhere. There's a good chance that with this, someone is going to be paying a similar sort of amount of rent to live somewhere. Don't forget, this number here is plus taxes and insurance. That's very important. Taxes, insurance on something like $300,000 is going to be another $300. So this really should be a $1,600 a month payment. Let's call it $1,650 for fun. This really should be a $1,650 payment because it's got to have taxes and insurance included in it. This amount here is only principal and interest. It doesn't include your other obligations, which are going to be taxes and insurance. Those are included in all monthly mortgage payments. But right there, $1347 is what we're really concerned about. That comprises that interest, that principal. Your total interest is the amount you're paying for that loan. So it's at least good to know. You don't have to understand it, but it's this whole column here. The next column across is the really important one. This is the one that shows you how much you've put into it. Now it's kind of reverse because it's not the amount you have, it's how much you've paid into it and reduce the amount you owe. Let me explain that a slightly different way. This payment here, this number, let's get rid of these. This number here plus this number here equals $300,000. Okay? That's a huge piece to understand, is that is the part that pays down the balance of it. This interest has nothing to do with it. This is money that you can chalk up and light on fire, say goodbye to. It's not like you're throwing it in the trash. It's for the privilege of borrowing the money. But it's this one here on the balance column that actually is how much you owe on it. And this is where the equity buildup is coming from and what people talk about. So let's do a little thought experiment here. Let's assume 1 year down. Let's go take a look. So November 22. We're gonna go 1 year ahead of time. Let's assume our purchase price of $350,000. The value of the house has not changed at all. We have been making our monthly payments all the way down, thus decreasing the principal and interest. Let's cross all this. So we've been going down here and we've been adding this. And at the end of that year, we owe $293,753.69. Now, what do you think you get out when you sell the house? You have to pay that loan back. And the value of it is $350,000. So, simple math. Let's just do it here. $350,000 minus $293,753. And like I said, I'm not going to do it for numbers here, but there would be realtor fees and some other closing fees that you should technically calculate into it. But just for sake of illustration purposes, we're just going to do that math real quick. You're left with $56,247. Okay? Now, as we know, you put a down payment in this. We talked about it at the beginning. You put down $50,000. The purchase price was $350,000. You borrowed $300,000. This $50,000, this little sum here, $50K, that's your down payment. You get to keep that. You get that back. So all you did is you kind of put it in the bank and just left it there. Technically, it gained interest. That's what this sort of stuff is. You get your $50,000 back when you sell the house. And what's all this extra stuff? What's all this extra exciting stuff? You got another $6,200. Where'd that $6,200 come from? Your principal payments, your principal pay down, your reduction in your principal amount. Because it's a forced savings, you're putting money to them. They've given it to you ahead of time. You give it back. It's in the house. It's in the walls. It's where's the money going? It's like I borrowed the money, but then now I have it and then I pay them back. Shouldn't I just be paying them back? Yes and no. It's part of paying back the amount you owe, and that means that you don't owe as much anymore. And at very least, if your house doesn't change price, you technically put some of that money back towards that principal amount. And it's the beautiful portion is another $6,247. And actually we can confirm that. If you were to add up all of these right here, and this is the beautiful part of the principal paydown, is that on a primary residence, we're talking simple terms here, you're at very least, some of your monthly payment, some of your rent is going back into your pocket. And in some way, you can almost think about it as for savings, which is why we say it all the time. You're basically forced to put the money back into the property. Now, this doesn't apply if the property value drops because it goes with it. But if it comes back past it, then you get it back. It has to exceed at least coming back to your break-even point, which is what you purchased the house price for. It works in tandem with appreciation values. The value of your house generally should stay the same or go up. That's what we're assuming. We negate crashes here. We don't talk about that nonsense because that's not going to help us. We can mitigate crashes by trying to buy at the right time and looking and getting in as often as we can and making as much real estate as we can. But there's going to be some money that you can make just from owning your own house. This is the difference between a renter and someone who owns their home. They get that money, plus they get the appreciation. And this one is the one that I think most people don't understand all the time. It's really, really important to get that you get to get that money back when you sell the house because you did borrow it, you put it into the house. Once it's paid off, you get it back. You get all of it back. If you got down to zero, you get the whole $300,000 back. Okay, I know that was a lot to digest, and I kind of even got a little lost myself. This is why it's a bit of a Let me show you the quick and easy way to get what you need out of this whole table so that you can understand what you've made at a glance. If we look at this again, this is really the only column you need to worry about, because at the end of the day, you know your monthly payment, you know there's going to be now you know that part of it's going to be towards the principal amount, you know that portion of it's going to be towards the interest. The only column you need to really worry about at this point is going to be the balance amount due. It won't actually be on your statement. There will be a balance due, so it will also be given to you at face value at where you are. But if you ever get lost, don't know where your monthly payment, your coupon is, you can actually go and just look at your amortization schedule and see. And if you want to set yourself a goal and know that, let's see, what's 5 years from now, let's do almost exactly 5 years from now, what I'm gonna be at, you can go ahead and make some life plans and goals calculating this in. Again, making some basic assumptions. Go ahead, search Google for average appreciation rate and start to do some math and some calculating around how much money you could potentially see from your house in that time. I like to be conservative, so even if you just took out the numbers raw and said, my house is gonna sell for exactly what I made, give me worst case scenario what I would get from my principal paydown. You take one of these numbers, you pick the one you want. Let's isolate one here. Santa's gonna give you a nice little Christmas present. So let's do a little calculation based on that. So if you take the sales price minus balance due, you get your down payment plus equity. That's gonna be a calculation that you can use to quickly find out how much you're gonna get. If this number starts to go negative, it means your appreciation and your purchase price or your sales price has gone down from what you originally put into it. But as long as this number is at the same amount that you purchased the house for, you're gonna get your entire down payment back and you're gonna get the extra money you have forced savings into it. Before we go, quickly, I want to talk about how this applies to an investment property. This is a whole other video, but as an investment property, the most amazing part, and I want to get you excited for the next video because you're going to go check it out, is that another person pays that down for you. A renter pays that down. It's one of the multiple ways you can actually make money on a property as an investment property. Now you get your cash, you get your principal pay down, and you get your appreciation. Those combined can be some hefty returns on the original cash you put into that property. So don't miss my next video talking about investments and actually making money on properties. I know there's a lot out there, but I'm gonna try and go over it just so it's like a little bit of a discussion about the concept, because I have conversations all the time with friends and family, and I find that not everyone fully understands it. They know there's money to be made, but they don't know where. And if you know where, then you know what to start looking for when you go to buying the house. And that becomes a really powerful tool, because that's how you decide whether or not something is a good deal and can make you money, or something's just kind of meh and isn't a great deal. Because you don't want to have your pants pulled down when you're trying to do something like purchase a property from a friend or family and thinking it's a good idea, but really the math doesn't make any sense. So I try to focus on the math. I usually go there a little bit thick. I go there a little bit deep in the weeds. That's just how I like to do it. I hope this explanation kind of helped you. Maybe you learned a little bit about it and you got a better understanding of principal paydown, the reduction in the principal amount that you owe when you borrow money. This applies to anything else in life, any other loan payments. It's generally going to be applied the same way. Doesn't mean if paying back a friend, it's going to be the same way. They probably want the full principal back when they get it. But this hopefully was helpful, not too confusing, and I definitely don't want to ramble here at the end. So let me know if that was at all helpful in the comments, because I'm really trying to get a discussion going about a lot of the terms and understanding how to make money and how to manipulate your properties and your investments to make more out of them. I think it's a big thing. I think it's really important that more people should do it, and I enjoy the conversation. So I'd love to know what you think. I would love to know if it was a little too complicated, if it made sense, if there was anything about it that you wish you knew more about that I haven't explained, or maybe I don't even know more about. Maybe I'm missing something. I would love to know a better way to calculate this, or go even deeper. Where can I make more money on my properties? So I don't know. Let me know.